to Eugene. Take it away.
Thank you, Dottie. Good evening, everyone. Thank you for joining. I know we're getting close to dinner time, and so we'll keep it brief and concise. Like Dottie was saying, my name is Eugene Choi. I'm with Dunham Associates. Been with Dunham for close to 8 years now. Been with Dottie for a couple of years as well. Before we get started, obviously, we got to go through the disclaimers. And so the views, thoughts, and opinions expressed here are solely my own personal views and opinions. They don't reflect the views of Dunham Associates Investments, and this is for informational purposes only. Doesn't constitute a solicitation or an offer to sell or advisory services, nor is it an offer to purchase interest or securities on Dunham and anything related to Dunham. So now that we got that out of the way, I wanted to rewind us a little bit back to June 3rd of 2022, and that's an odd date. But let's go from June 3rd, 2022 to March 31st, which was the end of last month, March 31st of 2023. So during that time, we got about 301 days or about 10 months of trading between those days. And on June 3rd, 2022, the market, and when I say market, I mean the S&P 500, was trading at $4,108.54. And on March 31st, 10 months later, which was the end of last month, the market, S&P 500, was trading at $4,109.31. And so during that 10-month time period, you had less than $1 change in the S&P. Now, obviously, a lot's happened between June 2022 and March 31st of 2023, right? And so if we look at the first half of June in 2022, the market ended the year of 2022 lower by 20% plus 20.6%, that was the end of June, right? So that's not where the market ended at the end of the year, but the end of June of 2022, it was the worst start to the S&P since 1970. So over 50 years. The Dow ended the first half of the year dropping at 15.3%, which was the worst start to the year since 1962. And then the NASDAQ had a 29.5% drop in the first half of the year, which was the worst start on record. So we are all living history. Congratulations. We've all lived through the worst first half of 2022 in history in the NASDAQ, and in over 50 years and 60 years in the S&P 500 and the Dow. So the reason is why, right? We all know the reason why. It starts with the letter I. It's the word that everyone is tired of hearing, inflation, right? And the rising risk of the R word, which we're all aware of, recession. So we take a look at June, which is where we started. The CPI and inflation index year over year, so we're looking at June of 2021 to June of 2022, was 9.1%. Now, that was the peak, right, of where inflation was. July year over year, so July 2021 to July 2022, we are at 8.5. August, we were at 8.2. October, September. September, 8.2. August, 8.3. October, 7.7. November, 7.1. So we've seen a downward trajectory of interest rates, right? And that ended our 2022. If we take a look at the increase in interest rates that the Fed has made to combat inflation, we started back in March of 2022. Interest rates were 0, and the Fed started increasing rates. So March, we raised by 25 basis points or 0.25%. May, we ramped up the rate of increases, and we went to 50 basis points in May. And then June, July, and September and November, we had 4 straight 75 basis point increases or 0.75%. December, we went back down to 50. February, we went back down to 25. Last month, we stayed at 25 as well. And so we have increased interest rates, and the Federal Reserve has increased the Fed funds rate the quickest in modern history. That was all in 2022, and then I went over the first couple of months in 2023. But we're going to recap 2022, end of the year, S&P 500 down 19.4%. the Dow Jones down 8.73, and the NASDAQ down 33.1%. And so I don't know about you or anyone on the call, but I am very glad 2022 is over. Now, let's focus on the big event that happened in Q1 of 2023. Silicon Valley Bank and this bank crisis that people have talked about, that you've seen on TV maybe. And so a very brief overview about Silicon Valley Bank. They shut down in March of 2023, right? That shutdown was the largest failure of a bank since Washington Mutual in 2008. To give you a little history about Silicon Valley Bank, they are obviously based in Silicon Valley. They had about $209 billion in assets in December of 2022. And most of their customers were startups from the healthcare and technology space from IPOs that happened in 2020 during COVID, right? That's when everyone was flushed with cash. You saw a lot of these private companies go public through what's called a SPAC. It stands for SPAC, which is a special purpose acquisition company. It's essentially a way for private companies to go public a lot quicker than going through the normal underwriting process to go public. But a lot of these customers and these companies were clients of Silicon Valley Bank. And so during the years of 2019 to 2022, with the $6 trillion that we stimulated into the economy because of COVID, a lot of these companies were flushed with cash. So what did they do with the cash? They deposited at Silicon Valley Bank, which is good for the banks. We all know how banks make money, right? They take in our deposits and then they use our deposits to lend out somewhere else or to invest their proceeds and their cash into what are supposed to be low risk investments, right? So that's exactly what Silicon Valley did. Most of their excess cash was purchasing treasury bonds, very low risk, very low return as well, because rates were zero back in 2019 and zero in 2020, right? And so a lot of the excess cash that Silicon Valley Bank had were in these long dated treasury bonds with longer maturities. Now, bonds and interest rates have an inverse relationship. That means when interest rates go up, bond prices go down. And so all of this excess cash that was placed into these treasury bonds were before interest rates shot through the roof when the Fed was raising rates, right? And so because they have that negative correlation, when the Fed increased rates as much as they have in the recent year or so, Silicon Valley Bank's balance sheets with their bonds decreased in value, right? As they were decreasing in value, and now they have a liability because their investments are losing value, these startup companies that money was really cheap to borrow they were struggling to borrow more money. And obviously with the rise in interest rates, they were struggling to hire. And so they were getting scared. And what do? They started withdrawing their money. So now you have two things working against Silicon Valley Bank. You have a declining value in their investments because of the rising interest rate environment. And then you have these startup companies that the majority, a good amount of their customers were these startup companies, started withdrawing money because they needed it. So that is a negative and a negative. And the straw that broke the camel's back was when Silicon Valley Bank in March decided to sell some of their investments. Unfortunately, because of what their bond prices have done, they had to sell at a loss. And that loss was $1.8 billion to be exact. Now, when news came out because of that, customers withdrew their money even quicker because they thought the bank was going to go under. And that's what we call a bank run, which is what we've seen through Silicon Valley Bank. And it was on March 17th that Silicon Valley Bank's VB Financial filed for bankruptcy. And then the Fed swooped in a little bit before that, but by that time, the damage was already done. And so you've seen, because of that, a ripple effect through some of these smaller regional banks as well. If you are all familiar with what happened in, Silicon Valley Bank is not the only bank that has suffered from having a lot of these losses in purchasing these securities. Another one that comes to mind, which I'm sure you have all read about, is Credit Suisse, right? The second largest bank in that area, right behind UBS, literally bankrupt. UBS bought them out. And so that is what happened this past quarter. Yet, even despite that second worst bank failure since 2008, the S&P through the end of 2023, March 31st, was up 7.03%. So how on earth, with all of this mess, with the tighter credit lending standards, with inflation still very, very sticky, with unemployment in the labor market very, very tight, with it being more expensive for these companies to borrow, how is the S&P up over 7% through the end of March? The S&P 500 is a market cap weighted index. What that basically means is different companies in the S&P 500 have different weightings and different influence on what constitutes the price of the S&P 500. So I want us to take out, first of all, the top 10, 15 stocks of the S&P 500 and think about the largest companies that you can think of that are part of the S&P 500. I'll give you a couple of them: Apple, Amazon, Microsoft, Nvidia, Google, Tesla, Facebook, now Meta, right? They account for 20% of the weighting in the S&P 500. If we take all of the technology out of the S&P, then through the end of March of 2023, the S&P is not up 7%. The S&P is up 2.5%. A lot more manageable, right? And it makes a lot more sense. And so these FANG stocks that you guys have heard of, Tesla through the end of March was up over 90%. Facebook, or Meta now, through the end of March was up over 65%. Nvidia through the end of March was up over 90%. These were the companies that got hit the most last year in 2022, right? And so is it FOMO and the fear of missing out and people thinking that they hit the bottom and that now they're going into this? Is it the extra stimulus money that people had because of COVID that they're now putting money into this? Is it what the millennials and the younger generation have been taught of buy the dip, which is what they're doing? Time will tell. We won't really know until we fully are past that event and can look back and say, okay, that's the reason why, the market has propped up as much as it has. Now, back to the inflation, where we are now, right? We talked about where we were. We then talked about Silicon Valley Bank, which was the big headline event in Q1. Where we are now and where we think we're going, where I think we're going. Inflation is a lot harder to bring down than what I think people think it is. It's very easy to go from 9% down to 8, down to 7, down to 6. It becomes incrementally harder to go from 6 to 5 to 4 to 3 to 2. And the Federal Reserve has made it abundantly clear that their target is 2%, right? They're not willing to budge and say, yeah, we'll raise our target to 3% because 3% is close enough. No, they want it back to 2%. And so the best analogy that I can give about inflation going down to the Fed's target rate of 2% is, it's called the last mile. So we've all ordered things on Amazon. We've all had things purchased and delivered to our houses. Amazon is a logistics company, right? They were a book company and a bookstore online first, and then they turned into like the online Walmart where you can buy anything you want. I would argue now that Amazon is a logistics company. When you order something on Amazon, within 3 minutes, it is already packed in its box and it is already put in a place where they just need to load it onto the truck or the van, and it's already out on its way to get to you. And that's in 3 minutes. Everything is automated. The reason why it's called the last mile is because the last and most expensive part of that process, from the time you hit buy to the time that it gets to your door, is loading that item in the van, is getting the Amazon driver to drive from the distribution center of Amazon to then go to your house, get out of the van, unload the package, drop it off on your doorstep, get in the van, and go into their next destination. That's called the last mile. It's the most expensive, and it's the least efficient. And so how that relates to inflation is that's the last mile, right? Inflation through the end of March, which just came out recently in the past couple of weeks, March 2023, inflation was down to 5%. That was the lowest that we've seen since May of 2021, right? February was 6%, January was 6.4, December of last year was 6.5. And so we've been in a trajectory going down and down and down and down. My argument is that it's going to be harder to get from 5 to 4 to 3 to 2, right? The last mile. And so the question becomes, all right, if inflation is still going to stay sticky, what is that going to do to the market, and where is the market headed? Inflation can fall down rapidly because just in June of last year, inflation was at 9% year over year. And this past month, inflation is now at 5% year over year, right? So inflation can go down, but costs don't go down for companies, right? The McDonald's next to my house right here is paying, in Nashville, Tennessee, is paying their workers $15 an hour. If inflation now goes down all of a sudden, are they going to go to their workers and say, hey, we are not going to pay you $15 an hour anymore. We're going to pay you $12 an hour? No. And why is that? Because the labor market is still really, really, really tight right now, right? So they need these workers. So if their costs remain high, but inflation goes lower, what does that do to a company's balance sheet? That reduces their operating leverage and it shrinks their margins. And we'll see with earnings coming out this quarter, when they give forward-looking guidance, they might not do as well. And so that is where we see things going, or where I see things going, is more choppy waters. Every single market that we're in, the market follows an economic cycle, right? Since the dawn of time, markets work through an economic cycle or a market cycle. And there's 4 parts to an economic cycle. There's an expansion, which means we're growing, market's going up, up, up. And then we hit a peak. And then after we've hit that peak, we go to a contraction, which is the 3rd stage in an economic cycle. And then after we go through a contraction, we shrink and shrink and shrink, and then the economy slows down and growth slows down, then we finally hit a trough. So we've already seen the expansion, right? That was from, I would argue, 2008 to 2022, right? I don't consider COVID a recessionary standpoint. That was like a 37-day recession. So let's say 2008 to 2022, expansion, peak in 2022. Now we're going into the contraction stage because of the rise in interest rates and the Fed's attempt to battle inflation. And we're going to the contraction phase. And I think there are 3 steps to an economic contraction. And we're not going to see the bottom, in my opinion, until we see these last 3 things. Thing number 1 is a bear market, which we saw in 2022. So we've already been through that. Thing number 2 is an earnings recession. And so an earnings recession is when these companies come out with their earnings. It's obviously 2 lower quarters and negative quarters of earnings for these companies. The S&P 500 in 4th quarter, their earnings fell a little over 4.5%. The expected earnings rate to fall for Q1, which is what we're announcing right now, as you see these companies coming out with their earnings, is 6.8%. Companies are really struggling to keep their margins up. If we talk about Tesla has slashed their prices on their cars even more, right? And they hit their targets of what the analysts expected, but the stock fell. And why did the stock fall? Because their margins shrank, right? And so that is the second part of the contraction. The first part was the bear market. Second part is the earnings recession. And then the third part, unfortunately, we're not going to know until we actually look back in the rearview mirror and say, there it was. And that's just confirming the economic contraction. We've seen some signs of the economic contraction being confirmed with the commercial real estate market rolling over, the contraction in credit now that we've seen with Silicon Valley Bank and these much tighter bank lending standards. The commercial real estate is a big one, and that's something that I'm looking out for and keeping my eye out on. Offices around America are half empty. Commercial offices. San Francisco, office vacancy rates, record high in history. And office space across the US has also hit a record high of 16.4% vacancy, right? No one to take it because they don't want it. And so I say that all to say that you guys on the call have been working with Dottie for maybe a short amount of time or a very long amount of time now. And I have personally met with probably over 1,000 financial advisors. My job is to travel across the Southeast United States and meet with different advisors and try to help them with their practice. And the one thing that I can say about Dottie, and what's the most important critical for you all as well, is that Dottie is coming from a planning perspective, which is the strongest, most highest rate of success, in my opinion, of getting through these markets. Because as long as the plan is intact, that's what the planner is for, to make sure that these types of environments and markets, they're going to happen all the time, right? We think, oh, this time is different. This time is worse. There's nothing like this time ever before. We've never seen anything like this. There is something out there which Dottie has used with you all in the planning stages. It's all done through the planning software that she uses when she does this with you. It's all done in the proposals that Dunham runs and any of your other investment managers that you might use might run. It's called a Monte Carlo simulation. And a Monte Carlo simulation basically takes into account over 1,000 different scenarios in the market. Hey, what would happen in the market and in a client account if we had this amount of bonds and stocks and John F. Kennedy got assassinated? What would happen to the stock market? Let's take into account if we went through a 2008. Let's take into account if we had COVID. Let's take into account if we had a Republican House, a Republican Senate, and a Republican president. Let's take into account the exact opposite. And so they go through 1,000 different scenarios. And what the Monte Carlo simulation is able to do is project where you should be and what returns your mix should have. And Dottie does that with every single one of her clients and with you as well, because she comes from what's most important is planning, right? We cannot time the market. And there are studies out there that you all can find online is results of timing the market. And they did a study where the average investor, which I would consider us average investors, we're not hedge funds or anything like that. We don't have insider knowledge. If we try to time the market, our investment performance gets cut in half. And so rather than timing the market, understand that this is just that contraction phase in that economic cycle, and we will hit that trough. And maybe we've already hit the trough, right? We don't know yet until we can look back and say, yeah, that October 2022, when the S&P was trading at 3,500, that was the trough. And so we might be in a longer expansion phase right now. But timing the market is not going to work. The studies show that it hasn't. Long-term investing through a financial plan, as long as the goals are intact. Some years you're going to have down years like 2022. Some years you're going to have years 0 or 5% or 2%. And some years you're going to have 20 or 25, right? And so make sure to continue to work on the plan with Dottie, because that's what her and her team at Full Circle Financial do better than 99% of the advisors that I meet with. And I'm not saying that because Dottie paid me to say that, but it's really from my experience of meeting with all of these advisors. She is a planning focused advisor. And so with that, Dottie, I'll give it back to you so that you can continue, or if there's any questions, and you can kind of give your 2 cents as well.
All right. Thank you, Eugene. All right. If you guys have questions, if you can put them in the chat for right now. I'm actually going to go over just a couple more numbers to give us just a little bit more detail and dig into some of what Eugene said, because I would say the biggest thing that I'm getting from clients right now is, okay, you know, the TV talking heads are telling us inflation has come down year over year, because like Eugene said, we peaked at 9.1 and then we just came in at 5%. But the question is, if inflation is coming down, why are we still paying so much when we go to the grocery store? And so what I'm going to do is I'm going to kind of show you those numbers to see if it makes a little more sense. Now, this is going to kind of get into what we call the weeds of the numbers. So don't get too overwhelmed by it, but I'm going to share my screen with you guys. And I'm going to kind of break it up so you can see here. Well, let's actually view that so it's a little bit easier for you guys. All right, so it's not going to let me do it. But basically what I want to show you is right here in the CPI numbers. So up here, this shows the CPI weight as of February 2023. So you can see housing had a 34% weight in the CPI calculations. Food and kind of building it down, but down here is where I really want to get into the numbers. So you can see here, food is still up 8.5%. It's still up 8.5. That's food, and then we got food at home, food away from home. So this is where inflation is showing, where they're saying that inflation has, you know, we're at 5% instead of the 9% numbers, because energy is down, energy commodities are down, gasoline is down. Of course, if I don't know if anybody went to the gas station this week, gasoline's not down, but we are actually down about $1.20 a gallon from where we were when we peaked. We have fuel oil, and then we have used cars and trucks. Those prices have come down. So you can see that a lot of the other prices, this is why a lot of people are confused about, you know, when we're told that the inflation numbers are coming down, why are we still paying so much? Well, that's because food and energy are pulled from inflation numbers immediately. And so those are not being calculated, but that still tells me that we're 5% higher than what we were a year ago on everything else, plus what we're paying at the grocery store, what we're paying at the gas station. And so that's the reason I kind of want to pull that in there. So what we have done, as Eugene has stated on the financial planning, is financial planning, the normal inflation is about 2.25%. And that's what the Fed keeps saying that they want to get back to, is 2.25% inflationary pressures year over year, which means they're hoping by February of next year, we're at 2% instead of, you know, the 6% that we were at, or the 5% we're at right now. So that's where they're trying to get to, but it still means you're paying more, right? Prices are still going up year over year. They're just trying to hope that prices aren't going up by 5%. They're only going up by 2%. But what we have done in the financial plans is we have adjusted that inflationary from 2.25% to about 3.75%, because in my opinion, I don't think the Fed's going to be able to get us back to the 2% inflation like they want us to. And so that's why we've adjusted on the financial plans. And if you have any questions on that, you know, reach out to us. But as you guys get your updated financial plans this year, you're going to see that the numbers have adjusted slightly. And that's because we've increased the inflationary pressures on your spending going forward. I don't see any questions in the chat. So do we have any questions for Eugene or for myself?
While we wait for that, Dottie, I just want to applaud you for doing that, because everyone that's listening right now, the raising the inflation rate to that 3.75 or 3.25 or 3.75 just shows how active the team is, because I could not agree more that it is going to be extremely difficult to bring that back down to the 2, even though that's what the Fed says. So we might be stuck in that 3 to 4% for a good amount of time, until unfortunately we go through that cycle and then we finally hit that trough, which might be something, you know, they say the Fed will increase rates until something breaks. Now with Silicon Valley, the thing that broke, we don't know until we can look back and say, yep, that was it. But again, it just shows how Dottie and the team are making sure that, you know, the numbers that are there are updated, so that you actually can manage expectations properly.
Okay, I still don't see any questions in the chat room. I know Eugene always does a fantastic job for us. Eugene always speaks in words that I can understand, and he affirms all that you do for me. So,
Yeah.
so Eugene, there you go. There's a comment. You know, so I don't see any questions in there. Now, if you would like to ask a question out loud, you can unmute yourself, and Eugene and I are going to stay on for just a few more minutes to answer any questions. But to be respectful of everyone's time so you guys can eat dinner, if you want to hop off and go enjoy your dinner, please feel free to do so. But if you do have a question for Eugene or myself, feel free to unmute yourself and we'll answer those questions for you.